Candlestick Zen. Trading always comes with risk. When market conditions are in favor of your strategy, you will make profit, and you will lose money when they are not. The trick is to maximize the profit without losing everything when the market goes against you. Control the risk, and you will save your account to trade another day. There is a simple but extraordinary technique to significantly reduce trading risk. You should adapt this technique to match the frequency of your trading. If you're not sure what is your trading frequency, watch the previous video, most profitable trading frequency you can possibly achieve. Let's say that you're a day trader. You trade almost every day. Let's assume that you have an account with a balance of $100. 100 is a nice and round number which will make our calculations easier. The technique requires you to have at least 3 different time periods to control the risk. As a day trader, you might want to choose the following 3 time periods. 1 month could be your long-term checkpoint. 1 week could be your mid-term checkpoint. 1 day could be your short-term checkpoint. First, you decide how much money are you going to allow your strategy to lose every month. For example, let's say that 10% is the maximum loss that you are willing to take every month. That means that if your first month goes very bad, you will limit your losses to $10. This will leave you $90 to trade with next month. If next month goes as bad as the first one, you will lose 10% of your $90, which is $9. You will begin the third month of trading with $81, and so on. This long-term checkpoint alone is already enough to keep your balance safe for a while. But we can do better. We still have 2 more checkpoints. Now we will work on the weekly risk limit. Weekly limit should always be lesser than monthly. Let us assume that your weekly limit will be 5% of your total balance. There are about 4 weeks in a month. It might seem that this is not in harmony with your monthly limit of 10%. 4 weeks times 5% weekly risk is 20% per month. That is greater than 10% monthly risk. The trick is that you must respect both limits at the same time. Let's say that you had terrible first 2 weeks in the first month and that you lost 5% each week. That is already 10% and you have reached your monthly limit. That means that you have to stop trading for the rest of the month. When the next month starts, the risk you used will reset and you will have fresh 10% risk allowance. This is good not only from the risk management perspective, it is also good psychologically. How would you feel if you had losses for 2 consecutive weeks of trading? Fear and anger would probably kick in and it would be harder to trade without emotions. And you need clear mind and calm soul to trade well. What happens if only your first week is awful and then, during the second week, you trade well? Imagine the following scenario. You start the first month with $100. During the first week, you lose 5% by Wednesday. Since you've reached your weekly limit, you stop trading for the week. You have $95 left. On Monday next week, you resume trading and you have a great week. You earn $10 and at the end of the week, you now have $105. Since you have 10% monthly risk limit, now you are $15 away from your stop amount. Even if you lose 5% weekly for the next 2 weeks, you will still not reach your monthly limit. You can already see how this 2-period risk control will protect you from losses, especially if the losses are grouped in a very short period. But there is still one more level of protection, the 1-day checkpoint. Since you have 10% monthly and 5% weekly risk allowance, your daily allowance could be 2%. As with weekly risk rules, we will apply similar rules to daily risk. You are allowed to lose 2% per day, but you cannot lose more than 5% weekly at the same time. If you lose 5% before the end of the week, you still need to stop and wait for the next week. If you lose 10% before the end of the month, you still need to stop and wait for the next month. Daily limit will prevent you from taking a full week loss in a single day. Weekly limit will prevent you from taking a full month loss in 1 week. In all examples, I used fixed percentage of risk that is set at the beginning of the month, meaning you start your first month with $100. Your monthly risk for that month is going to be $10. Your weekly risk will be $5 per week, no matter if you start the week with less than $100, more than $100, or with exactly $100. Your daily risk will be $2, no matter what your balance is at the beginning of the day. At the end of the month, you recalculate the risks for the next month. The fixed percentage is easier to calculate than updating the risk every time your balance changes. After you get comfortable with this technique, you can start calculating the risk dynamically. Every time your balance changes, you recalculate your monthly, weekly, and daily risk allowance. This way, you will reduce the risk even more while making larger profits. The only disadvantage is that dynamic risk requires more frequent calculation, but you can easily make a spreadsheet and automate the calculation. You could also automate the process by coding. In this example, I assume that you are a day trader. Swing traders should have different periods than day traders. Instead of daily, weekly, and monthly risk allowance, swing traders could use weekly, monthly, and semi-annual risk allowance. Scalpers could use hourly, daily, and weekly risk allowance. You can also modify the numbers to match your trading style and strategy. Instead of 2%, 5%, and 10%, with more aggressive trading, you could use 3%, 8%, and 15%. More conservative traders could use 1%, 3%, and 8%. Do your own analysis before you apply this technique. Always manage the risk of your trades. Do not be greedy. Trading is not a sprint, it is a marathon. Never trade without knowing how much you could lose. Control the risk or it will control you. Candlestick Zen.